They told you the silver market was calm. They told you prices were stable. They told you banks were in control. That was a lie. Because right now, silver has broken the system, and the biggest banks in the world are trapped by their own game. Pull back the curtain for a second. This is not about a price chart. This is about leverage, paper promises, and a physical metal that is quietly disappearing. And the villain in this story is the same one every time. Paper markets pretending to control something that exists in the real world. Pull up your phone right now. Do it. Search COMEX registered silver inventory. Look at the number. As of early 2025, registered silver sits near 30 million ounces. That sounds big until you realize this. The COMEX trades contracts representing over 800 million ounces. That is more than 25 paper ounces for every single real ounce available for delivery. Do you understand what this means? 1 ounce of real silver is holding up a mountain of promises. Think about that for a second. This didn't happen overnight. It was built slowly, quietly, year after year. Back in 2015, silver was ignored. Prices hovered around $15. Banks used it as a funding tool. They shorted it. They leased it. They treated it like an unlimited supply because no one was asking for delivery. By 2020, something changed. Silver crashed with everything else, then snapped back hard. Prices ran above $28 in months. Retail buyers showed up. Mints ran out of product. And yet, the paper market kept growing. COMEX open interest exploded while inventories barely moved. That was the first crack. Then came 2024. This is where it gets serious. Global demand crossed 1.2 billion ounces in a single year. That's not an estimate. That's from the Silver Institute. Mine supply was under 830 million ounces. Recycling filled some gaps, but not all. That left a massive deficit, over 200 million ounces short. That's more silver than the COMEX is registered right now. They were printing contracts. You were stacking reality. Now, here's where it gets interesting. JP Morgan, the biggest player in the silver market. For years, they were the dominant short. But quietly, they flipped. They accumulated over 1 billion ounces of physical silver since the 2010s, according to public filings and vault data. That's more silver than most countries hold. Why would a bank short silver on paper while hoarding it in vaults? Ask yourself that question slowly. Meanwhile, China entered the picture in a big way. Chinese imports of silver surged in 2023 and 2024. Industrial demand exploded. Solar panels alone now consume over 15% of annual silver supply. That's up from under 5% a decade ago. Electric vehicles use 2 to 3 times more silver than gas cars. AI data centers need silver for high-efficiency power systems. This is not investment demand. This is consumption. Once it's used, it's gone. Let me show you exactly why banks are trapped. Silver prices in 2015 averaged around $16. By 2020, they averaged $20. By 2024, they pushed past $25. Now, spot prices hover in the mid to high 20s, even with constant paper suppression. That's a near 75% increase over a decade. Your savings account did nothing. Your cash lost buying power. Their silver became insurance. Imagine you worked for 10 years. You saved dollars. Those dollars stayed numbers on a screen. Meanwhile, institutions converted cheap paper into hard assets. They were accumulating ounces. You were accumulating promises. They were preparing. You were told everything was fine. But wait, there's more. The real stress doesn't show up in the headline price. It shows up in delivery. COMEX warehouses are bleeding metal. Every time price dips, silver leaves the vault. Why? Because buyers are demanding physical settlement instead of rolling contracts. That is the nightmare scenario for a paper market. Here's what they're not telling you. If even a small percentage of contract holders demanded delivery at the same time, the system breaks, not glitches. Breaks, cash settlement, force majeure, rules rewritten overnight. Do you think they'll protect you or the system? Now, connect this to your life. You wake up one day. Silver reprices higher. Not because of hype. Because there is not enough metal. Your grocery bill is higher. Your rent is higher. Your savings buy less. But the people who prepared hold something real. Something finite. Something the system cannot print. They were positioned. You were distracted. They were reading inventory reports. You were told silver was boring. They were pulling metal out of the system. You were trusting the system. And then between late 2024 and early 2025, something happened that changed everything. A quiet shift. A flip so important that once you see it, you can't unsee it. Because this is the moment when silver stopped being just an investment and became a threat to the entire paper market structure. That shift was simple but explosive. Delivery requests spiked. Not traders rolling contracts, not speculators flipping paper. Real buyers demanding real silver, and the system was not built for that. Here's the flip. For decades, banks controlled silver by selling paper. They didn't need metal, they needed confidence. As long as most contracts were settled in cash, the game worked. But when delivery demand rises, every short position becomes a loaded weapon. Let me show you why this matters in pure money math. JP Morgan and other bullion banks still carry massive short exposure through derivatives. When silver moves up $1 per ounce, that is not a headline. On just 500 million ounces of net exposure, that's a $500 million swing. Now imagine silver moves $10. That's $5 billion. On $20, $10 billion. Do you understand what this means? A sustained move higher is not painful. It's lethal. This is where the system starts breaking. Look at COMEX data from mid-2024 to early 2025. Registered silver inventories dropped from roughly 36 million ounces to near 30 million. That's not normal drift. That's a drain. At the same time, open interest stayed elevated. More claims, less metal. That gap is stress. Now here's where it gets interesting. The paper price says silver trades around the high 20s. But try to buy real metal. American Silver Eagles trade $5 to $7 over spot. In some weeks, premiums jumped above 30%. Paper says 28, physical says 35. That's a massive disconnect. That's the market screaming that price discovery is broken. Think about that for a second. If paper price was real, physical would follow. But it's not, because physical supply cannot respond. You can't print silver. You can't rehypothecate an ounce that's already gone. Here's what they're not telling you. COMEX rules allow for cash settlement in emergencies. That sounds technical. What it really means is this. If they don't have the metal, they pay you off in dollars. But dollars are the thing losing value. Silver is the thing holding value. Which one would you rather have? Now layer in the second squeeze. China. China is not buying silver for speculation. China is buying silver because it needs it. Solar manufacturing capacity in China expanded aggressively in 2023 and 2024. Each solar panel uses silver paste. Less silver per panel than before, yes, but far more panels overall. Total silver demand from solar now exceeds 180 million ounces per year. That's more than total global investment demand some years. And it's rising. Add governments. Add defense systems. Add grid upgrades. Silver is essential for conductivity. There's no substitute at scale. Copper can't replace it in high-efficiency systems. Aluminum can't match it. This is physics, not opinion. So now you have pressure from both sides. Investors pulling silver out of vaults. Industry consuming silver permanently. Supply barely growing. New mines take 10 to 15 years to develop. Most silver is mined as a byproduct of other metals. You can't just turn on more silver production because price went up. Do you see the trap forming? Here's the part that should make you uncomfortable. The official price is used for contracts, accounting, and risk models. But the real price is being set in the physical market. And that real price is higher, much higher. Every ounce that leaves a vault tightens the noose. Let me show you exactly how this plays out. A bank sells paper silver to cap price. Price dips. Physical buyers step in. Metal leaves the system. Inventory drops. Risk increases. Bank needs price lower to manage exposure. But lower price accelerates physical demand. That's the feedback loop. That's the dual squeeze. They were relying on apathy. They were relying on paper settlement. They were relying on you not caring. But now the market cares. Look at London. LBMA silver inventories also declined through 2024. Not collapsed, but trending down. At the same time, lease rates spiked. That's the cost to borrow silver. And when lease rates rise, it means metal is scarce. That's not a theory, that's plumbing. Do you understand what this means? Banks are fighting on two fronts. Rising industrial demand they cannot control. And rising investor demand they cannot suppress without making the problem worse. They were liquid. You were patient. They were leveraged. You were physical. They needed confidence. You needed ounces. Now you might be thinking, didn't silver try this before and fail? Didn't it spike in 1980 and crash? Didn't it run in 2011 and collapse? Didn't the system survive every time? That's the right question. And the answer is, what makes this moment different? Because the players, the demand, and the debt levels today are nothing like the past. And once you see that comparison clearly, you'll understand why this time the system doesn't have the same escape route. That's the objection everyone reaches for. They say silver always runs and fails. They say the system always wins. But that argument only works if you ignore what's different now. In 1980, silver was cornered by two private players. They used leverage. They faced a system with low debt and high interest rates. The rules changed and the trade died. In 2011, silver ran on fear after a financial crisis. But industrial demand was weaker and inventories were higher. Banks had room to breathe. Today, none of that applies. Back then, global debt was manageable. Now it's over $300 trillion. Back then, interest rates could rise without breaking governments. Now every rate hike threatens collapse. Back then, silver demand was mostly investment-driven. Now it's industrial, structural, and non-negotiable. They had hype. These players have necessity. They had traders. These players have factories. They had time. The system doesn't. Here's what they're not telling you. Silver demand is not just growing, it's compounding. Solar alone is expected to consume over 200 million ounces annually within the next few years. That's nearly 1/4 of global mine supply. Electric vehicles add another 60 to 70 million ounces per year as adoption grows. AI data centers are silver intensive because power efficiency matters when energy costs explode. Then add medical devices, defense systems, and grid upgrades. This is not optional demand. This is built into future infrastructure. Now look at supply. Global mine output has been flat to declining. New discoveries are smaller, grades are lower, costs are higher. Most silver comes as a byproduct of copper, lead, and zinc mining. If those markets slow, silver supply slows too. You can't flood the market even if price doubles. Do you understand what this means? It means higher prices don't fix shortages, they expose them. Now let's talk about price reality. Paper markets can delay repricing. They cannot prevent it forever. When physical silver trades at consistent premiums, that's the real signal. When delivery times stretch, that's the real signal. And when mints ration product, that's the real signal. Price lags reality until it snaps. Here's where it gets uncomfortable. If silver moves from $30 to $50, that's not extreme. That's a return to inflation-adjusted norms. If it moves to $75, that reflects structural deficits. At $100, paper leverage implodes. Every $10 move higher transfers billions from shorts to holders. That's not speculation. That's math. Let me show you exactly what to watch. First, COMEX registered inventories. If they keep falling, stress is rising. Second, physical premiums on coins and bars. When premiums stay high, even on price dips, supply is gone. Third, silver lease rates. Spikes mean scarcity. Fourth, Chinese import data. Rising imports mean industrial pull. Fifth, policy responses. Any sudden rule changes tell you pressure is extreme. Each of these is a warning light. You don't need all of them flashing. One or two is enough. Now here's the part no one likes to talk about. When systems fail, they don't fail politely. They don't send emails. They don't give you time. They change the rules overnight. Cash settlement, trading halts, position limits, all legal. All devastating if you're on the wrong side. They were diversified on paper. You were concentrated in reality. They trusted models. You trusted physics. They needed everything to work. You needed one thing to fail. Ask yourself this. Why are central banks buying gold? Why are institutions accumulating commodities quietly? Why are inventories falling while demand rises? Is this coincidence or preparation? Think about that for a second. 10 years from now, there are only two outcomes. You will either say, I saw this and acted, or you will say, I saw this and did nothing. Both are choices. Both have consequences. If you acted, you hold something real in a world of promises. If you didn't, you hold explanations. Explanations don't pay bills. This is not about fear. It's about awareness. It's about understanding that systems built on leverage eventually meet reality. And silver sits right at that fault line. If this opened your eyes, share this video with one person who needs to see it. Subscribe to the channel. Comment "Wake Up" below. The rest is up to you.